Hi guys, it's Stacey here from tycoonfactory.com and I'm making this video today with a little bit of an overview of Andrews Pitchforks, so what they're about, how to draw them. So I'm going to start by briefly talking about why we want to trade pitchforks, what the benefits of them are. So I'm sorry if you've previously watched my compounding video because this part of the video is going to be very similar to that, but I need to explain this before I go into any of the technical side of it. So let's say we enter a trade and this green line here is our entry point and we're entering a buy trade. So what we're hoping for is for price to move up like this, and it means that all of this movement here, all of these pips we gain, is profit. Happy days. But obviously sometimes price doesn't do that and it comes down the opposite way, and that would mean that all of this movement here would be drawdown on negative equity. Now what traditionally people would do to try and combat this is they would put a big stop loss down here, and this could be 30, 50, 100, 200, sometimes even more pips than that. So it's a lot of pips. And what they were hoping for by doing this is that price would continue down and then turn and come back up towards our green entry point. The problem with this is this whole section here is drawdown, and so that means that all of these pips of movement, you're not actually gaining any money until you've got back to this green line and back up again. And so actually speaking, all of that movement you've missed out on. Worse still, the other scenario is that the price would actually come down and hit your stop loss and you would get stopped out for this 200 pips or whatever it is that you've set it at. So you can see that this isn't an awesome way to trade. So what we've been doing, because of the pitchfork tradings and how specific the entry and exit points are, is we've actually been putting our stop loss here. So we're using between a 5 and 10 pip stop loss, sometimes even less, but I won't go into that right now. And basically what that means is that if price does move the wrong way, it means that we're only losing this amount of pips. It also means we can then look for another entry point down here to re-enter, and we actually gain some of these pips here. Not all of them, but we actually gain some of these pips here, whereas this person here did not gain any of these pips whatsoever. So that's one of the benefits. We use a tiny stop loss, so that means that we can actually gain some pips that the traditional trader would not necessarily gain. Another benefit of pitchforks is because we're using such a small stop loss, we can use a much higher lot size for the same risk. So let me show you how that works. So I'm going to head over to a Forex risk calculator here. And let's say we've got a balance of $1,000 and we want to risk 2% of our account. Now, if we were the trader who had a 100 pip stop loss on a trade, we can use a 0.02 lot size. So you can see that if we had an account of $1,000, we wanted to risk 2% of our account on the trade, and we used a stop loss of 100 pips, we could only use a lot size of 0.02 in order to only risk the 2% of our account. Now watch this. If we were only using a 10 pip stop loss, which is exactly what we do with pitchforks, we can have a $1,000 account, risk 2% of our account on the same pair, and we can use a 0.19 lot size. So you can see we're making a lot more per pip than the person who uses the big stop loss. And so this is the benefits of using pitchforks, because what they allow you to do is to really pinpoint exits and entries of your trades. So I'm going to talk you briefly through how to draw a pitchfork in a moment. But first of all, I just want to talk a little bit about pitchforks and where they come from and the background of them. So a pitchfork, and I'll just quickly show you what one looks like. So a pitchfork looks like this. So it's a very simple format, as you can see, and I haven't shown you how to put that on a chart just yet. So you've got an upper parallel, a lower parallel, and this line going through the middle of the pitchfork is called the median line, and that's the most important line. And basically the pitchfork was identified by a guy called Andrews, who did a lot of studying on charts and stuff, and what he identified was that if price was coming up from the lower parallel, it had an 80% chance of getting to the median, and the same from the upper parallel down to the median. So providing we get these pitchforks in the right place, that gives us a really good indication of what price is going to do once it's inside the pitchfork. And I'm going to show you next how to draw a pitchfork. So if you just give me 2 seconds, what I'm going to do is I'm going to just make a note on here, and I'm using TradingView, but you don't necessarily have to use TradingView. So first up, we've got a downward fork, and a downward fork consists of swing high, swing low, previous swing high, and an upward fork consists of swing low, swing high, previous swing low. And I'm going to show you how to draw those now. So like I say, I like to use TradingView. I find the charting software very good. It has a lot of tools, and pitchforks are built in there like it is to most trading stations. So what we're going to do is select our pitchfork tool, and we're going to start by drawing a downward fork, which would be swing high, swing low, previous swing high. So some trading stations you would actually draw the fork in this order: swing high, swing low, previous swing high. But as it happens on trading station, you actually draw the previous part first. So I'm going to go and find a previous swing high, and this is one here, and I'm just going to click there. I then come down to the swing low and up to a swing high. And what that does is draw a traditional pitchfork. So this is what we call a traditional pitchfork. And I'm just going to pull that over a little bit so you can get a better idea of that. So as you can see, price starts to bounce around in here. And obviously this isn't tradable yet because we're waiting for some bounces on the parallels and the line. So we're waiting for confirmation really that this fork is going to contain price well. So at the moment there's no trade in this fork as such, but we're waiting for this to either come back up and bounce off the upper parallel or come down and bounce off the median before we start and trade it. So that's how to draw a downward fork. I'm going to quickly show you how to draw an upward fork. Very similar, just the opposite. So we're going to select our pitchfork tool, and we're going to find a previous swing low. So we're going to use this here, then a swing high, and then a swing low. And so as you can see, this fork has a little bit more data. So what that means is that because prices started to move through the fork, it means that potentially we could trade this straight away because there may be already bounces from the median line from the upper parallel. Now on this particular one there isn't. So as you can see, this green candle here got pretty close to bouncing off the median line, but it didn't quite get a to the pip touch, which is what we're looking for. So we wouldn't trade this as it stands right now. So this is what's called a traditional fork, and this is what you need to draw a traditional fork. Downward fork, swing high, swing low, and previous swing high. Upward fork, swing low, swing high, previous swing low. And so that is a traditional fork. Now, there's also something called a best fit fork. Now, what that does is it allows us to tweak the fork a little bit. So you can see that that candle there was really, really close to just touching that median line. So what I may do is just swing the fork that way a little bit, and that gives us the touch on the median line. Now that doesn't mean that we would trade that because we've just kind of put that in there ourselves. So we would need to wait for extra confirmation on this fork, like a bounce from either the upper or the lower parallel, in order to confirm that this fork is containing price and that price is adhering to the fork lines. So that's how you draw a fork, and I've covered traditional forks there and best fit forks as well. So one of the things I need you to take a note of is this here, because that's what you need to draw a traditional pitchfork. And then your best fit, you are basically just grabbing the tail of the fork and moving it around until you get some good touches on the outer parallels and onto the median line as well. So that's how you draw a fork, and I know I've gone through that really, really quickly, and obviously if you've got any questions just ask, but that's how you draw a fork. So when it comes to trading a fork, what we're looking for is we're looking for to the pip touches. So that means, like when we moved this to a best fit, how we had that to the pip touch of the wick on the median line, we're going to be looking for those moves in order to trade this fork. So whether that be a bounce off the upper parallel or a bounce off the lower parallel, that's what we're looking for. So yeah, okay, there's not going to be trades constantly. You can't just log on, draw a pitchfork and be ready to trade it. You've got to wait for the perfect entry points. But it's those perfect entry points that allow us to use that tiny stop loss, therefore the bigger lot size, and therefore much more profit per pip than the traditional trader. And the other thing is as well is that when you do get a bounce to the pip off the median line or one of the parallels, you're waiting for a slight pullback. So you can see here, this came down, it bounced off, and then there was a slight pullback of a couple of pips, and that's when you would enter the trade. So when it's pulled back a couple of pips, same if it bounces off the lower parallel, for example, it would come down, it bounces, it pulls back a couple of pips, 2 to 3 pips, then you can get into the trade because that's made its move. What you're not looking for is consolidation around one of these lines. So what you don't want is for price basically to come in and be doing this around this area. We don't want to get into those trades where price is like not deciding what it wants to do and it's kind of just teetering around that area. We're looking for a very clear cut like this. It's a move down, then it's a bounce off, and those are the trades that are more likely to succeed. So a couple of other points to remember when you are trading these forks. In an upward fork, you are better off buying on the lower parallel. So you're waiting for price to come down and bounce off the lower parallel. It retraces a couple of pips, which is fine. And then let's just say that it takes a little while, but it starts to come back and it retests this line. And then it comes up again and it retests this line, and it keeps doing that. For as long as you're on a buy trade on an upward fork off the bottom parallel, you can see price is actually still moving up. So basically, eventually, even if it is coming back and retesting this lower parallel all the time, it means that you are actually getting into profit. So you don't need to worry too much about that if it's taken a long time. And the opposite side of that is if you're on a downward fork, you want to wait for a bounce off the top parallel. So you're waiting and you're trading it down on a sell, which again will eventually bring you into profit. So when do you get out of a trade? Now this is really down to personal preference. Some people would say, I'll take the bounce off there and wait for it to hit the median before I actually get out of the trade. Now bear in mind, 80% of the time it's going to get from there to there. So there's 20% of the time where it's actually not. And so you may lose out a little bit there. So it may be that what you actually do is you wait for it to move so far into profit and then move your stop loss to break even. So it's then a risk-free trade. So then the 80% of the time it does get to the median, great. The other 20% of the time you haven't actually lost anything. So that's one way to go about it. And remember, you start your stop loss at 10 pips. So you have a 10 pip stop loss from your entry point, and that is what you put into your MT4, your trading view, or whatever platform you're using as your trading station. However, what we also do is we actually draw a little stop loss line up to here, which might be between 2 and 5 pips, depending on how close our entries are. And so basically what we do then is until price gets to a certain level of profit, we watch in case price actually comes outside of the fork and hits this line here, at which point we would manually take ourselves out of the trade. We still have our 10 pip emergency stop loss on down here, but this is just kind of a manual stop loss so that sometimes we're actually only losing 3 or 5 pips in a trade that doesn't go the right way. So if we do get a perfect bounce, but then it comes back up and it then comes back down, retraces, and then comes out of our pitchfork, we're actually only losing 3 or 5 pips, whereas you could let it just stop out at your 10 pips. But your gain here, 80% of the time, is going to be much greater anyway. So I hope that makes sense. I know that I've covered an awful lot in that very, very short session. If you've got any questions, please do ask.